Wall Street is increasingly worried about inflation's resurgence. Recent signs of stickier-than-expected inflation have some Wall Street strategists concerned that investors have become too optimistic about the odds of a soft landing in the U.S. economy. The prevailing concern is that inflation could enter an era of stagflation where price increases will accelerate while economic growth slows. This was most famously seen during the 1970s and the 1980s when the swift move down in inflation proved to be a head fake and the U.S. was left fighting higher prices for more than a decade. We believe that there is a risk of the narrative turning back from the Goldilocks towards something like 1970s stagflation with significant implications for asset allocations, JP Morgan chief market strategist Marko Kalanovic wrote in a note to clients on February 21. He expects the S&P 500 to fall to 4,200 by the end of the year. A string of hotter-than-expected inflation reports in January have led Kalanovic and others to conclude that inflation's bumpy path to the Fed's 2% target should have investors worried that stocks sit at all-time highs. Although it's a low probability, it's likely that investors are underestimating the chances of stagflation in the next 12 to 18 months, State Street Global Advisor Chief Investment Strategist Michael Aaron told Yahoo Finance. And I think if anything, the last few years have taught investors that kind of low probability outcome happens far more often than the statistics suggest that it should happen. If stagflation were to take hold, real assets like commodities outperform stocks and bonds per Aaron. Should this kind of low probability outcome occur, investors will be better afforded by having a modest allocation somewhere in the 5% to 10% range into some of those kind of real assets, Aaron said. The inflation debate. MarketGate.com chief strategist Michelle Schneider flagged stagflation as a key risk for 2024 in January's edition of the Yahoo Finance chart book. She noted startling similarities between the path of the consumer price index CPI when she first began working in market in the late 1970s to now. In the 1970s and 1980s inflation story, an oil embargo and a war in the Middle East helped spark inflation. The government spent significantly during and after the Vietnam War, which also contributed to rising prices. These factors painted a similar picture to now. Impact from the COVID pandemic and recovery caused inflation to surge higher, and conflict in the Middle East have impacted oil prices and fuel supply chain issues. Government spending also remains a key concern. Schneider highlighted some warning signs already flashing in commodities. Sugar futures are up 4 times their pre-pandemic prices per Schneider, and cocoa prices have surged too. Invesco's agriculture ETF is pushing against the high since during the 2022 inflation surge. There are some real issues here within food, which is kind of exactly what happened in '79, Schneider told Yahoo Finance on February 27. Add on that, oil just passed $80 a barrel for the first time since November, and many of the same ingredients that sparked the return of inflation at the end of the 1970s are at play today, per Schneider. She added that a key turn, silver future outperforming gold, has yet to happen. One of the risks to stocks is that the Federal Reserve won't cut the rate as quickly as market hopes. Investors are pricing in 3 interest rate cuts in 2024 per Bloomberg. Apollo Global's chief economist Thorsten Slock predicted in a note Friday that the Federal Reserve won't cut interest rate at all this year. Underlying measures of trend inflation are moving higher, Slock wrote. But many economists have argued inflation is clearly headed lower. Capital economic chief North American economist Paul Ashwood told Yahoo Finance he believed this bout with inflation will be more similar to the price spike after World War II, which didn't end in stagflation. The key difference in the 1970s brought a whole succession of supply shocks, he said. The prospect of geopolitical tension causing oil prices to jump even more this year always remains a key risk, Ashwood said. But for now, oil prices remain lower than seen during the 2022 spike. Ashwood highlighted other factors like the surprise growth seen in the U.S. economy over the last year, which could indicate an uptick in productivity. This would keep the economy in balance even if demand remains strong. We think the odds of a near-term resurgence in inflation now are quite low because even if demand remains strong this year in response to Fed rate cut, there's plenty of scope for further significant gains in the supply side of the economy, Ashwood wrote in a research note on January 26.